Time now for a technical look at the markets. Joining us is Sid Mokhtari, Chief Market Technician at CIBC Capital Markets. Sid, thanks very much for joining us.
Thanks for having me.
A very interesting time. How are you approaching what's unfolding right now?
So we think we are in a transitioning cycle that is often associated with late stage patterns, i.e. This is a cycle that has begun showing a preference toward commodities, industrial, transportation, even by some measure, utilities and staples in the back end of it. So we think this late cycle transitioning will bring about some volatility, and at the risk of stating the obvious, some of the tariff negotiations or some of the geopolitics that is happening. All that is part of, in our opinion, is part of this late stage cycle that we have been witnessing over the past, call it 12 months.
And how, when you say late stage, whereabouts within the late stage would you say we are?
That's a good question. I think late stage cycles are often tied to inflationary, reflationary growth that be tied to economic ISM numbers over 52, 55 that again boost industrial production as well as need and demand for transportation, if you will. All that is part of a growth narrative that should come into the market, and it's typically inflationary, and eventually the talk of rate cuts will probably stagnate, and we may go into a period where there are no more cuts per se, and maybe the rest would be more about a rate hike at some point. Too early to talk about any of those things, but at least the market is beginning to show some of those historical evidence that we are in a more favorable environment that has a growth backdrop tied to commodities, reflationary bias, industrials, transportation. Those are the kind of areas that we're seeing that performing better with durable technical indicators, breadth conditions. That's where we have been focusing over the past, call it, few months.
And is the focus strictly commodities?
Not just commodities, anything that is tied to commodities and associated areas, i.e. industrials, as well as transportation. But generally speaking, commodities are the initial source of signaling process for us. We've seen base metals that are participating better. Obviously, gold and silver were the primary dominant drivers of the commodities boost, but we have now seen participation from commodities like aluminium, zinc, and coppers of the world. We're now seeing a big surge in breadth of the energy sector, and these are all typically associated with a cycling through a late stage narrative by historical measures.
Okay, and we have some sub indices that we can pull up. Any ones you want to focus on particularly?
I think industrials would be a very good area of focus for us, as well as maybe energy, along with if you got base metals, that would show quite well too.
But we've got first up is
industrials would be a good.
Industrials is the first one up there, Sid.
Oh, perfect. So technically speaking, as you would agree, going back historically, you are at fresh new all-time highs. We saw similar patterns within the U.S. Transportation that finally, after 4 years of a sideways pattern, confirmed U.S. industrials, and that's called the Dow theory signal. Again, that itself is a condition often associated with the late cycle patterns. But industrials in general are showing a very strong breadth environment. They're showing a lot of good quant factors. Trend oscillators have also been very supportive for durability of relative and absolute performance within the industrials complex. So I would say that's one area that we are heavily focusing, not just in Canada, but also in the U.S., as well as Japan and other areas around the globe. Industrials are certainly a good area of focus for investors.
And is that because, pulling that chart back up, they've been fairly flat, haven't they, for the last year? Little bit.
Correct. Within industrials, if you look at That's because of the composition of the index, if you would agree. There are, within the industrials, there were the likes of rails, that heavyweights of the index, as well as the waste management companies that are heavyweight within the industrial sector. Those were, somewhat stagnant or sideways, so kept this, sector chart more on the flat side. Within it, you've seen, things like EIFs and MDA and other nichier areas in industrials that have worked quite well. So if we approach industrials from a more stock specific selective process and not necessarily passive process, I think you'd be able to be surprised how strong the sector would have produced alpha for us.
All right. And what was the other chart you wanted to pull up? Was it energy?
Sure. We can also look at the energy sector.
All right, let's take a quick look at that.
I mean, because at the risk of stating the obvious, as you would agree, geopolitics have had a major influence of the performance of the sector. But we also want to say that we know that based on historical measures, between late March through to early June, the sector has a very strong seasonal hit rate at about 70%, with an average return of about 2 and a change per month. So this is an area that not only shows well on charts, shows well on its internals from a breadth perspective. We're looking at about a 90% breadth expansion. In other words, broader constituents of the energy sector are now above their 20-day, above their 50-day, above the 200-day. It's a condition that is historically associated with dip buying. We do assume pullbacks within the sector will be well received from a dip buying perspective, as well as the fact that seasonality backdrop is supportive all the way into, call it, late May, early June.
Okay, we have to wrap it up there, Sid, but thanks as always for joining us.
Thanks for having me.
Sid Mokhtari is Chief Market Technician at CIBC Capital Markets.